Hey guys, this is Scott Horne, and in this video we're going to take a moment and just talk about navigating owner financing if you have a marketplace where your interest rates on a traditional mortgage are dropping, and what does that look like and how does it affect things. So I hope you like the video. If you do, take a minute and like it, please. Don't forget to comment below if you have any comments, and hope you can come over and join our YouTube channel as well. Everything correlates to each other in our marketplace, guys. If a current mortgage rates are 7%, how does that relate to our seller finance rates? Well, can you be 2.5, 3 points higher? Certainly. And I think things that you've got to look at are not just the interest rate differential. It's looking at your property taxes, insurance, and things of that nature. It's looking at the dollar value of your property. The lower the value, the higher the rate. The higher the value, the lower the rate. Things that really I talk about to get started in as I'm looking at this, although I do look at the existing mortgage marketplace, what I'm really looking at is the rental marketplace. And how do we compare to that? Because that's what really drives the seller finance business. The current mortgage market rates might be important to look at, but that's not the main goal. It's what do the rents look like in that area? Just because interest rates go down doesn't mean rental rates go down. As mortgage rates go up, certainly rental rates go up. And they might get adjusted a little bit if they get to be too high. Got it. But that's where I start by navigating, is going, can I sell my home somewhere between 110 and 120% of rental? And what does that number look like? And of course, I'm going to back out my actual taxes, back out my actual estimated insurance, and what I have left over can be applied to principal and interest. So what's that going to look like? And I just back into my numbers with an amortization schedule where if I want to ask X dollars for my property and get a certain down payment, and I have my loan amount, I can simply enter my loan amount, enter my payment amount, enter my term of my loan, say 360 months, and calculate what that interest rate may be. Now that rate could come back at 7%, it could come back at 12%. Okay, in those situations, maybe I need to think about a few things and make some adjustments out there. And you've got to understand interest rates. At least here in Texas, if you are 10% or higher and doing seller financing, your buyer technically should not be paying for loan servicing. We, the seller investor, have to pay for loan servicing. That's the Savings and Loan Administration issue that's out there. If you are at 12% or higher, there might be some issues from disclosure perspectives you've got to provide your buyer on a constitutional basis. That's what the RMLO is going to do for you and take care of that if you're working on a seller finance deal on the back end. But we've got to understand the relationship out there and how this works. When the mortgage rate is high, can we sell a higher interest rate? Absolutely we can. And that can be something that's reasonable. But at the end of the day, when you look at all that combined, the question is going to be, is that monthly payment, principal, interest, taxes, and insurance, and maybe your admin fee or loan servicing fee, reasonable for that property, and will someone buy it at that monthly payment? If it's too high, you are adjusting your rates down. If it's too low, you can push it up a little bit. Hopefully it comes right into that sweet spot and it works. But you've got to look at all of those factors to make the proper decision. You know, what does not change in our marketplace is the DTI, or the debt to income ratio of borrowers. Big banks under Dodd-Frank, et cetera, have been regulated typically to a 43% maximum back-end debt to income ratio. We investors are not regulated by that. We're regulated under a reasonable standard. And every deal is going to be a little bit different, meaning you could probably push that up to 50%. Can you go to 80% DTI? Yeah, probably not. But borrower ability to qualify for a loan really doesn't change just because interest rates drop. Somewhere between 80 and 85% of the population cannot qualify for an A+ mortgage. So if they can't get that mortgage, they really are stuck with three options. They can rent a property, go live under a bridge, or do seller financing. And at that point, if they want to own the home and you have a reasonable price on there and reasonably monthly payment that's affordable to them, that becomes a very viable option. So whether our mortgage rates are at 7 or 8% or they're at 4%, it's not going to change that game that much because of those purposes. What it does though is it may affect our cost of financing. So if my bank rate drops from 8%, let's say, to 6%, does that give me the ability to offer maybe a little bit lower owner finance rate to my back-end buyer? Certainly. If my DSCR rate goes from 8 to 6, does it give me that different ability? Absolutely it does. And that's really when interest rates affect us the most, is how it affects our financing, because buyers are buyers and people are people, and their habits don't change, unfortunately. Their debt to income ratios stay high, the ability for them to qualify doesn't change, and so they're stuck in our owner finance world with higher rates, unfortunately. If they want to change their habits, get good credit, great, let them go take advantage of those lower rates. It's just that the great majority of people don't ever do that, is what drives our industry and has never changed, at least in my 35 plus years of doing this business. Did I say 35 years? Good Lord, I'm not that old. I was a child prodigy, y'all. Anyway, just understanding the dynamics and how that stuff works is so important. It doesn't really change that mental mindset. A lot of times a home buyer might think because mortgage rates are lower, they should get a lower rate. And of course, my comment to them is, well, can you qualify for a loan? No. Well, then that rate's not even available. It's off the table. And from there, it's just the ability for me to structure my deal at the right monthly payment that works for that property for that time, that allows me to sell the home. So guys, I hope you found this helpful and some of the ideas out there about seller financing and its relationship to interest rates. If you did take a minute and like the video, please make any comments and come join our YouTube channel. We'll see you all next time.